exceptional responses worked. There's many other parts that have not worked at all, but that particular aspect has been addressed reasonably well. So we'll see. It's yeah.
Well, Boris is out.
Yes, he is, and he's recuperating. And I think he was right to say that it could have gone either way, because the stats are 50-50 if you're in ICU. And that's globally. It was there in China. It's here in the UK. That's just it's not even a protocol difference. I think it's just the severity of the disease. But it's even worse if you get on a ventilator. If you get on a ventilator, it's a 67% chance of not coming off it alive. So it's one thing to say you need the ventilator capacity, but really, if you're that far gone, it's really tough. He was very unlucky, and I think he seems to. I'm sure he will recover fine. And the issue is when will he be back? And I think actually, interestingly, although he's not well liked in some circles, I think everybody wants him back. There's a legitimacy to his leadership that is surprising, really. I can't.
The other fellow, I can't remember his name, the foreign secretary. He's not really known very well, or.
He's not known as he did run for the leadership, but he's not as ebullient and optimistic. He's kind of more of a suit, and he's incredibly bright. He's a former lawyer, and we actually have remarkably among the cabinet is full of incredibly smart people. You may not like all their policies, but there's no question about that. Rishi Sunak is much better than Sajid Javid ever was, and so he's better than a safe pair of hands. I think he's respected in cabinet, and that's what was needed. I don't think he's a popular figure, but I think he's an efficient and respected figure. And that's why he'll hold it together. And there was no question that Johnson wanted him to step into this role because he trusted him. So that's important. But it's very different. It's not a presidential leadership. The cabinet is very different. And there is a sort of symbolism that Boris represents, and a sort of tiebreaker. But it's not the same as the sort of amazing adversarial exchanges between Trump and the governors, which is just astonishing, actually.
But he did admit now that there are states' rights.
Oh, he has. Oh, that's good to hear.
Good to know. Thank God he said it.
Yeah, we have our own devolved issues. We've got four countries here, right? And they each have their own parliament, or assembly, or whatever. But they seem to be able to collaborate at this point. So that's a benefit of being much smaller, I think. But there's a lot that's gone virtual and still functioning very well. The Bank of England, which I'm on the board of, is completely virtual, including all wholesale settlement. It's just amazing. In terms of, they couldn't have done this even 10 years ago with everybody working from home and keeping the financial system going. It is truly incredible. And I'm sure the Federal Reserve's doing the same, but the need for these systems to work with the kind of latency that is required and repeatedly is just huge. And I think there's a reasonable amount of global cooperation on that level as well. so the dollar lines are out in order to make sure that there isn't too much currency pressure. But the that's technology is our savior at the moment in an odd way, both from an operating point of view and ultimately from the science that will defeat this. And I think that's a really interesting tectonic shift in where the place of science in society. Actually, I really hope it embeds itself and stays, because we were losing it, and this hopefully will reverse that. I don't know how you feel, or whether your scientists are getting the airtime that ours are, but I think ours are getting a lot of airtime at the moment.
We're getting some. I mean, I think there was a poll that was out that was, sort of who's the most trusted figure on the, sort of COVID crisis, and Dr. Is it Fauci came up with the most trusted public figure, and Trump, I think, as the least trusted.
How many did they have to choose from?
Yeah.
I think they only actually had about 5 or 6. So,
no. Yeah, I'm amazed that Fauci's survived, frankly, because he very subtly contradicts Trump all the time. And
sometimes not so subtly.
well, okay, but I'm surprised he's survived. But yeah, I mean, there will be criticism of some decisions, I know, but by and large, I think it'll be if we get through it and there isn't a second surge, that's the key. Is that we can get enough in place that there isn't a second peak, which I think would be really demoralizing. And so that's, this move by Google and Apple to provide the APIs for contact tracing is fascinating, because A, they've never cooperated before, B, it will reveal exactly how capable they are of surveilling the entire global population, which is remarkable. Yeah. And C, they will have to demonstrate their ability to be trusted and to various governments. And it'll be interesting to see if they can do that they really are going to, manage this information and keep it temporary and anonymized. But if they do, it could make a huge difference. Not in China, obviously, because China will do its own thing, but almost everywhere else in the world. And so I don't know. I think at the moment, the government is cooperating with them and trying to build a COVID tracker on top of their platforms. So we'll see. We'll see how the public takes to that. But I think it's going to be completely necessary, and will it be well enough managed that it genuinely can protect people as well? So from a tech perspective, that's one of the most interesting things that happen. From a science perspective, it's the whole race for a different style of vaccine, the ones that have really never worked before. That's also very interesting. So we've got 6 companies contributing in one way or another to our in their own small ways, and that's just a tiny selection of startups that are making a difference. So there are, as you say, silver linings. What company of yours is benefiting the most, being on the optimistic side, Dan?
There are actually a few. In terms of my portfolio, there's a company that is called Jure, which is a B2B wholesale marketplace. So retailers and wholesalers primarily in the apparel business, but also in the home decor business, connect and do assortment planning and budgeting and ordering all online.
Yeah.
And at some level, it takes the place of trade shows. And so it's in many respects, you could look at it as a virtual trade show. So obviously with what's going on, Fashion Week, starting with Fashion Week, I should say, but now nothing is really being done, and there's actually I'm trying to remember the name of it now. It's a multi-billion-dollar public company that is the largest trade show provider in the world, and that's all they do, trade shows. It's a huge business, and they're obviously in a complete brick wall scenario, and they've been reaching out to partner with Jor, and the Jor's itself has seen an 80% jump in revenue and orders. So anything that's done virtually is really something that people want to substitute for.
Yeah.
And then there's kind of necessities. We have a premium human grade pet food company, which is a direct to consumer, and they've actually seen orders jump up just on a monthly basis about 60%. People don't want to go to the pet food store.
Yeah.
They look at their pets as kind of children in a sense, and so the tailwind they've gotten is pretty massive. In terms of just wanting to have things delivered. We also have one of our portfolio companies is Instacart, which is doing phenomenally well. As you know, I think it was 300% jump in
wow.
revenues from month to month. They literally cannot process all the orders right now.
Yeah.
So those are sort of the types of companies that are really doing quite well in this mess. And then there's certainly companies that are we have a couple of retail companies or companies I should say that are omni-channel, and the online piece of things is actually doing reasonably well. The offline piece of it is just getting utterly crushed.
Anyone who's not gone digital as well as physical is just being killed at the moment. The one stock in the FTSE 100 that's maintained its value is Ocado. You probably have never heard of it, but Ocado is an online grocer that is, but importantly, is highly automated. So it delivers from these amazing warehouses where there's almost all the pick and pack is completely done by robots, which means that there's a final soft goods phase, but it means that the social distancing that's required in the warehouse is easy to maintain, which is not true in even Amazon store warehouses for that matter. And they're above their January high in terms of market cap. But they're about the it's interesting because they were sort of re-rated from a food retailer to a tech company about a year ago when they finally started licensing their entire technology suite to other retailers, and I think this will continue to grow for them. So they're using the profits from the online UK business to basically fund an entire technology solution business for the world's grocers, which is really going to be interesting.
We have a company called Berkshire Grey, which is a robotics company that does automated
pick and pack,
and they actually have the robotic arm is the software that manages that is actually able to detect very small items and know exactly what they are, which is quite an AI challenge.
Oh yes, absolutely.
That they've been able to solve, and so that company's also seen tremendous uptick in orders. I think a lot of what's happening though, this is the robotics, online necessities, shopping virtualization, those are kind of things that were going to happen anyway. This
Yes.
is just something that is just, the momentum of it is, it's just like a massive 500-mile-per-hour tailwind for those things.
Yeah, it's the Lenin quote, right? Sometimes you wait decades for something to happen, and sometimes decades happen in a week, or whatever.
That definitely describes the past few weeks. Yeah.
Yeah. I haven't got it right, but it is a quote from Lenin.
I prefer the Churchill quotes.
No, you don't like all of them.
That's
it's like you can trust America to do the right thing after it's tried everything else. Do you like that one?
There we go. Okay.
That seems to ring true right now. Yeah.
Yeah, no kidding.
All right. So we're about 2 minutes now out. One thing I wanted to say, Olav, I don't know if I said it before, but a lot of times, even if you say in the beginning to use the Q&A, people won't do it until you actually say oh, we just got a question from so-and-so. It kind of spurs it in them to be like, oh yeah, questions. So if you don't see them coming in, I did ask Ben Madison to log in and kind of start asking questions. So if you just go to one, it will sometimes just help spur it. So don't get scared if you're not getting any in the first half hour. Is essentially.
Yeah, I'm not worried.
Okay. And then do you have any other concern? Anyone have any questions, concerns? Maybe just put your phones on mute, turn off your email so it's not kind of buzzing in the background. Yeah. And yeah.
I'm trying to look at camera, but it unfortunately in a corner, which is really difficult.
I think it's fine if you don't stare directly. I mean, the way you were speaking to us before was fine.
Okay. Right.
Yeah.
Yeah, it's hard because the cameras on these screens and laptops are always at the top, but that's not exactly where you're looking.
Yeah, where your eyes
mine's
go.
at the bottom. I've got a Dell, not a Mac.
Oh, interesting.
So yeah, no, it is hard. It is hard. I have to tell you, it's the first time I've dressed up in 3 weeks.
Did it feel weird?
Yes.
Yeah. Same.
I could probably still wear shorts, but.
Yeah. Pajamas is part of the webinar.
I'm assuming, yeah, on the bottoms for sure.
Yeah.
There's one of our alums I was speaking to, and she said her work is doing pajama day, on Zoom. And she was like, I feel really uncomfortable about it.
A little awkward.
Yeah. All right, so we're about at a minute. I'll let you know when it's noon, and then we'll just go completely silent. And then I will hit start. So again, just give it a minute to kind of cycle through. All right, so we're at noon. So I am just about to start.
All right. Hello and welcome to Yale SOM Exchange webinar, No Exit, What's the Future of Venture Capital? The Yale SOM Exchange is the Yale School of Management series of online conversations. The series provides alumni and the entire Yale SOM community with opportunities to keep learning about faculty research, current events, and career strategies. I'm Olaf Sorensen, the Frederick Frank 54 and Mary C. Tanner Professor of Management at the Yale School of Management. Today, I'm joined by two amazing SOM alumni who are leaders in the venture capital space. Dan Ciperin is the general partner at Canaan Partners. Dan invests in and works with startups, most notably in the areas of fintech, e-commerce, and marketplaces. He was the first institutional investor in Lending Club, now a multi-billion-dollar public company. Dan joined Canaan after serving as chairman and CEO of Shopee.com, where he took the company public. Prior to that, he was a senior VP of MasterCard International, running their global debit program. Dan earned his bachelor's degree from Princeton University and an MBA from the Yale School of Management. I'm also joined by Ann Glover, CEO and co-founder of Amadeus Capital Partners, the international technology investor, which has raised over $1 billion for investment in high growth companies. Ann has been an active venture capitalist in the United Kingdom for 30 years. She's a former chair of the British Venture Capital Association and of Invest Europe. She's a member of the London Business School's Private Equity Institute Advisory Board. Ann was appointed as a non-executive director of the Court of the Bank of England in 2018 and became a member of the investment committee of Yale Corporation in 2019. Ann holds a master's from Clare College, Cambridge, and an MPPM from the Yale School of Management. She was awarded Commander of the British Empire Honors for her services to business and is an honorary fellow of the Royal Academy of Engineering. So I want to say just a little bit to start about what the format of today's webinar will be. I first plan to spend about half of the time, 30 minutes, on a set of questions and materials that we put together before this session. But then for the second half, we plan to transition to open questions from the audience. If you're interested in asking a question, I would encourage you to use the Q&A box in Zoom that you should see at the bottom of your screen to submit a question, and then I will monitor those questions and ask them, as many of them as possible. I'll start that at about 12:30 p.m. Eastern Time. So before starting out, I recognize that COVID-19 is something that's on everyone's mind. I'm sure that many of you have been personally affected by the crisis in multiple ways. We do hope, I think I speak for all of us when I say that we hope that you and your loved ones remain healthy. We do plan to discuss COVID-19 and how it might affect venture capital and entrepreneurship. But before diving into that, I want to start by reviewing a few trends that have been emerging in venture capital over the past few years, just as a way of kind of setting the stage for our discussion. Let me open a set of slides here. So one of the things that is true, if you sort of looked at venture capital, kind of leading up to the last few months, in many ways, it looks like, we're hitting all-time highs. If we looked at the amount of capital that's being invested in early stage companies, that's been growing rapidly. And in fact, in the last couple of years, has hit levels that hadn't really been seen since the dot-com era. But in some ways, those statistics may mask some other changes that have been happening that may mean that it's actually becoming more challenging for certain types of venture capital investors. So there's kind of three trends that I want to briefly highlight. The first one is that the time that it takes to exit investment, so the time between when the first investor puts money into the company and when the company is able to either IPO or perhaps exit through a trade sale, M&A, has actually been increasing over time. So this is just looking at essentially from the Great Recession from 2008, the last financial crisis, up to 2018, what was the average time that it took for a company in the US to exit based on the time when the first venture capital investment had been made. And what you see is that, in 2008, it was holding steady at around 5 years, but that's been gradually sort of creeping up over time. That puts a fair amount of stress, particularly, I think, on the earliest investors in the companies, because if you're raising your money in a 10-year limited partnership, you would like to exit the investments before the end of that. If the average time to exit is 6 or 7 years, then oftentimes 50%, even of companies that have successful exits, will not have that exit within that 10-year time frame. Another issue that's been coming up is that there's actually not that many IPOs. Now, there's been a lot of press attention around some very high-profile IPOs, some very large IPOs recently. But if we looked at, kind of how companies are exiting, still the dominant exit mode is through a trade sale. So the red line here is showing how many exits from year to year occurred through a trade sale or M&A activity. And the green line is how many happened through IPOs. Again, one of the reasons that can be important at the industry level is that on average, IPOs have higher returns. Not only do they have higher returns, if you're invested in the company longer, not those sort of IRR-based returns will be compounding. So they'll have much higher absolute returns. And the last thing that I think is kind of interesting is that there's been an increase, a small increase in usage in something that's known as a liquidation preference or multiple liquidation preference. So venture capitalists are typically investing not in common stock, which is what would be traded on a public exchange, but using preferred shares. And those preferred shares come with a set of rights associated to them. One of the rights that is often associated with preferred shares is what's known as a liquidation preference. So if the company is liquidated, and that could be going bankrupt, but that could also be being sold through a trade sale, is a liquidation event typically, then the venture capitalist would potentially get their money back that they had invested, maybe even a multiple of that money, the amount of money that they invested, even if the exit value was not very high. So to give you a sense of kind of what that might mean, in a very simple example, what you usually see is the liquidation preferences are increasing in later rounds of an investment. So a Series A investor might just have a 1x liquidation preference. So they have a preference equal to the amount of money that went in. But in some companies, a Series B or Series C or later investor could have a preference multiple that's 2x, 3x or more of the amount of money that went in the event that the actual exit event is not that large in terms of the value relative to the amount invested. What that means is that the investors will take their liquidation preference, the amount they're guaranteed as part of the preferred shares, rather than just taking their sort of proportion ownership in the company. That has the effect of essentially pushing the kind of value that's brought out of the company towards later stage investors. So, you know, if you sort of think about what some of these trends might mean in the industry, I think that, you know, it can mean that it's, you know, at the same time that the industry is enjoying some of its highest levels of investment, that in some ways it has become more challenging for early stage investors, both because of these sort of longer times to exit and because of the sort of shift in value towards the later stage investors. So what are the consequences of that? So there's two consequences that I think could be interesting. So one that I looked at a couple of years ago and was a little bit surprised to see the statistics was to look at when venture capitalists form a first-time fund, how many of those venture capitalists are able to raise a second or subsequent fund? And it turns out that the proportion has mostly been declining over time. So in the 1980s, the proportion was around 45%. As you'll see in this chart, from 91 to 95, if you started your first fund then, you had a 40% probability of having a second fund. It actually went up during the sort of dot-com era to almost 45%. And since then, it's just been steadily declining. So for funds where the venture capitalists raised their first fund in 2011 to 2015, the proportion that have been able to successfully raise a second fund has dropped down to 30%. You know, so it seems like entering venture capital or persisting in the venture capital industry, you know, has maybe become a little bit harder over time. One additional potential consequence of that is that there may be less money, particularly at the early stages for investors. And so the other trend that's sort of interesting to note is that even though the amount of money being deployed in venture capital has continued to rise, and you know, 2018 and 2019 were essentially record years, the number of first financings, companies that are getting their first venture capital investment, has actually been on the decline since 2014. Now, whether that's a matter of the sort of supply of entrepreneurs, that there aren't enough interesting businesses to invest in, or the supply of capital, that there's not enough early stage investors to invest in all of the interesting companies, I think is an interesting question, and one that I will continue to explore. So that's just a little bit of kind of background information that I wanted to provide. And I want to shift now into getting some insights from our panelists. So, both of you are really, pretty active and do early stage investing. And, I've given you sort of one picture in terms of statistics, but I'd be interested in hearing your own thoughts on how you feel that segment of the venture capital industry has been changing over the past, kind of 10 to 20 years. Maybe we could start with Dan.
Sure. So Canaan is a early stage venture fund. We invest only in early stage companies, and by early stage, the nomenclature's shifted around a lot, but it's generally speaking seed, Series A, and Series B. We do an occasional Series C, but that's not really where we focus. We have actually found that early stage investing is a great place to play. A lot of the larger funds, and by larger funds I mean private equity funds and very large growth capital funds, have tended to shift down into the capital stack and try to make investments in more early stage companies. And in some cases, that early stage could be a Series C or Series D for those folks. And as a result, it's become a lot more competitive in terms of dollars. We find we've been around for 30 plus years. We're on our 12 funds. So we find that that actually the early stage arena is a fantastic place to play. At least it has been for us. With respect to the liquidation preference issue you described, I think that is really, or at least I'll speak to just our experience, which is that you generally speaking only see that in a company where there's deep distress. In most cases, you would not take a term sheet or financing that had structure to it that was, in some cases, you wouldn't even take it if it were senior to the last round. Usually you try to insist on pari passu preference, but you certainly would not take a 2x. 3x is, in my experience, is almost unheard of. But you certainly would try and not take a 2x unless the company, again, were just in deep distress and there was really not much other choice. I will say that in some earlier times, I would say, not that long ago, where people, entrepreneurs in particular, were really striving to become a unicorn, to become a $1 billion plus company in terms of valuation. We did hear and saw a fair amount of cases where the entrepreneur, the founder, would take a higher valuation term sheet, but it would in fact be loaded with the kind of preferences that you described in your slide deck. And I think that has proven to be in most cases a mistake. And I think if you asked a lot of entrepreneurs who did that, whether they would do it again, I think the answer would be a resounding no. And certainly we always encourage and hope that our entrepreneurs, our founders, would not in fact take a term sheet like that. So certainly it does exist, but again, in our experience, it's really very distressed companies. A company that is doing well should, generally speaking, and in our experience, have no problem getting a term sheet with usually with pari passu preference or at most a senior preference on the next round.
Mm.
Thank you. Anne?
So, I think the early stage segment of the venture industry has been particularly strong and will remain strong. And it's a function of how easy it is to start a business. I mean, the world has changed in the last 20 to 30 years. An entrepreneur can get access on a variable cost basis to immense computing power, can design products very fast with a small team, test them easily. And that's in the tech side. And even on the health tech side, less so in biopharma, you can actually get really far along on very small amounts of capital. So we find that being in the seed and Series A, and we have funds that are early stage and late stage, is a great place to be, because you can really help work with an entrepreneur to set the DNA of a company, to help professionalize it, add team members, and it's become a recruiting magnet, really. There's a big shift in Europe to being interested in working in startups, even if you're not the founder. So we find that the resources required to start, world-class companies with really big ambitions has changed dramatically. So early stage is the best place to be, and it's even the best place to be in a crisis, because essentially even if you don't have revenue, you can manage your cash burn down, extend your runway, and still make progress. Whereas at later stages, where you've really relying on a revenue stream and a high growth rate, that's what's going to be massively impacted by an economic downturn. So we expect some of the companies that we've just invested in, or we're just continuing to invest in, to be among the most successful ever of our portfolio. So I think early stage is going to be really good place to be. On the liquidation preference point, I completely agree with Dan, and we tend to see it in a distressed company, or where there's a big unwillingness to accept basically a down round, a pricing down round. And some other shareholders or management would think they would prefer to have this multiple preference than a repriced round. And we spend all our time persuading them that the right thing to do is to accept the down round, and if you have to, because it sets an inequality among the shareholders that leads to really bad decision making at exits. I mean, it's not just the value migration that you showed. Sometimes it's complete stalemate, where people block exits that really could happen because of the difference in returns that you are illustrating. So yes, while it's a feature of the landscape, I think the most experienced entrepreneurs and investors are trying to avoid it.
So, in one sense, I'm not surprised, since both of you sort of do early stage primarily, that you both think early stage is a good place to be. But I guess I would follow up. So, one of the things that I do find curious is the fact that it's becoming less common for first-time venture capitalists to be able to raise a second fund. Do you have any thoughts about why we might be seeing that trend? Anne, do you want to maybe start?
Well, I mean, you have to have a denominator. I don't know how many funds have started. So we're a growing industry. I mean, when we started, which is 23 years ago, we were pretty much the only dedicated tech VC in the UK. So that it's become a crowded market, and although it hasn't grown as exponentially as PE, it's certainly grown. And I think it's been easier to enter as a first-time fund in the last 10 years during this sort of bull run, which means that I'm not surprised that it will sometimes be the fact that people who have entered just don't deliver. And when they don't deliver, then LPs don't support the second fund. I'm actually surprised that it's as small a trend as you're showing, to be honest. And I also think it's harder to deliver the exceptional returns that existed in the 80s and the late 90s in today's world. I think it's harder to build the exceptional performance, which is why it requires experience.
Dan?
Yeah, I completely agree with Anne. I think that it's all about the denominator. I suspect the denominator has grown very, very substantially since the certainly the early 2000s, and I think that as a result, the second fund then becomes the point in time where you have to prove, did you actually do a good job or not, whether it's on the basis of markups or more ideally on the basis of actual realized returns. And I think that the natural trend in that regard would in fact be a downward trend. It would be interesting to see the growth in the formation of first funds. And what the data would show there. Certainly anecdotally, again, to Ann's point, every VC newsletter or blog post that you turn around, you can't help but be struck with the 10 references to 10 brand new funds that have been raised by new folks that are trying their hand at venture capital. So that's obviously just anecdotal, but I suspect the data on the denominator would show that there's been a pretty massive increase in the number of funds as well as the amount of capital in the business.
Yeah, I think that's a fair point. The other thing that, I haven't really had time to do proper research on this, but that I think it may have been changing a little bit is the proportion of funds that are started by people who have some experience, perhaps, working for, one of the, high status existing firms and then spin out and create their own fund versus really just, kind of starting on their own, without much background in the industry, and that may have shifted over time.
Yeah, I mean, and I think we should expect a massive change in the next 12 to 24 months too. In talking to some placing agents and the like, they are saying that that LPs are now valuing the people who've lived through the two prior crises of the dot-com bust and the financial crises, because if you haven't lived through it, if you haven't lived through this before, it's basically flying by the seat of your pants. I mean, we're all in massively uncertain times, but having lived through a couple of crises before really helps in terms of addressing what should be done for the portfolio. And that experience is something that I think will be valued more in the next 12 to 24 months than it has been in the last 10 years.
Yeah, I agree with that. I also think, to a certain extent, raising a venture fund is a little bit like raising money for a company. In a company and the seed, and to a certain extent, the Series A, you're selling the dream. In the Series B or the next round after that, you have to show that you've actually realized the dream, or at least part of it. And it's very difficult on a Series B, and I would think the same thing for a second-time venture fund, to continue selling the dream if you don't have some reality attached to it that shows that in fact you've done the job that you set out to do.
Yeah. So Ann, yours was kind of a nice comment, was a nice transition to what I want to get into, which is, COVID is clearly dominating the news cycle. In many ways, it appears to be devastating economies, at least in the short term. We'll see, how long that may last. How do you think the crisis is going to affect the supply of venture capital? And you mentioned that you thought LPs would, maybe be more interested in at least maybe maintaining positions in some of the more experienced funds. But do you think are we going to see some of the same type of pullback that we saw from riskier liquid investments that we did, in 2008 and the years following it?
It's very difficult for me to know, because the asset allocation issues that the big LPs are facing are encountering massive swings at the moment. I think those who are experienced in venture and understand its long-term nature and will stay. I really think that venture will pull through really quite successfully. The two broad areas that venture invests in, technology and life sciences, are both accelerating aggressively under this crisis. Everybody is learning how to run video meetings. Everybody is going to end up with a COVID tracker on their iPhone, in some, or they're probably in most countries. There is, the science that is accelerating in all of the diagnostics and vaccine development, etc., is just all part of what we invest in. And so I think that the need and the respect for the ability for technology to actually make a difference is only going to accelerate. So there will be some LPs that really get that and continue to support, and there will be others who have massive denominator problems in their asset allocation where they won't be able to. So if I was going to call it, I would say it's probably slightly down, but not massively, and more on a sort of uncertainty of decision making than it is on kind of a big swing. This is a crisis it's unprecedented. Everybody's talking about it that way, but it's not hitting our industry square on the way it's hitting hospitality or travel, where they're completely shut down. We are still working. We are still functioning. We are completing deals. We are, it's difficult, but we're functioning.
Yeah, it's an interesting question about the LP part of this in particular. I completely agree that the LPs that have experienced, and certainly the venture capitalists that have experienced the two previous crises, if you will, and at least from the standpoint in 2001, specifically tech, and then 2008, obviously everyone, and now we have COVID. The issue with LPs that at least we saw pretty much across the board, not just in our firm, but certainly what we heard in other firms, was the LPs actually had at that particular moment a real liquidity issue. And they simply did not have access to cash for capital calls. And so as a result, we had some requests, and not even demands, but requests certainly to slow down from the standpoint of capital calls, because the liquidity at that time was really problematic. There are many issues with respect to the COVID crisis we're in now, and in so many ways, I think it's much worse than the 2008 crisis. But one thing that, at least to date, does not appear to be at issue is the liquidity, because the Fed has sort of thrown everything at this thing from a liquidity standpoint, much more than the 2008 crisis. And so again, at least to date, you don't have a liquidity problem. You certainly have a massive economic downturn problem, but the liquidity itself does not, at least now, seem to be an issue. And I do think most LPs, and certainly most venture capitalists that have lived through those times, understand that the vintages that they represent, meaning if you were actually investing in those times that where full-blown crises were in play, that those returns were actually significantly better on a median basis than returns in good times, in good vintages, if you will, or vintages that had good economic times, I should say.
Right. No, that's true. Historically, funds that were raised during sort of troughs, if you will, in the kind of capital cycle have done better. So this may be an opportunity. So shifting to thinking about the other side, maybe of venture capital equation, how do you think the crisis might affect the supply of entrepreneurs? Historically, at least, some of the strongest companies in the tech world have actually been born during previous financial crises. Should we expect the same this time around, or is this different? Dan?
Yeah, I think the first answer to your question is we should expect the same thing, and certainly I'm very hopeful that we will experience the same thing. Absolutely, that is, generally speaking, there is at some level, I suppose you could think about it as a little bit Darwinian, in that people are, the entrepreneurs that are really able to fight through something as difficult as this are ones that ultimately will end up succeeding. And there are certainly lots of evidence of that today, as well as certainly 08 and 01. I think that probably the biggest question mark that we have as a firm with respect to funding and finding and continuing to invest in those entrepreneurs is the question of how do you do that when you cannot meet in person?
Yeah, exactly.
It is, you know, venture is a very face-to-face, interactive, relationship-driven business because you're investing at a time where, you know, the primary thing you're investing in are the people, the team, as much as the concept and the business idea behind it and the technology behind it. So when you're not able to actually meet face-to-face, Zoom is a wonderful tool, but it's still not the same. You know, I think that's an open question as to how often and how able we will be to do that, assuming this continues to go on for quite some time. We did have our first deal approved by our investment committee that was entirely done, diligence and everything else was entirely done via Zoom, and there was actually not a direct person-to-person interaction. It was an unusual situation, hopefully not that unusual, but it certainly was a company that was growing very, very rapidly before the COVID crisis, and if anything, seemed to have an accelerating growth rate even coming into the crisis. So, and we certainly diligenced very deeply and referenced very deeply the team. So it can be and will be done, but I think it's much harder and will be much less often than you would like, given the nature of our business as far as it relates to person-to-person interaction.
I mean, I completely agree on that point, and sorry to bang the early stage drum again, but because early stage tends to be a more local business, it will pick up faster than, you know, businesses and due diligence that require getting on a plane anywhere. So I expect that as soon as the lockdowns begin to soften, you know, we're looking at deals. We haven't done a completely virtual deal. We've certainly completed deals that were in the pipeline, but we haven't done a completely virtual deal yet. But I know we're evaluating them. We're doing all of the work, and perhaps meeting the team will be the last thing we do before finalizing a deal. But I expect that when the lockdowns come off, it'll be a lot of the local early stage opportunities that we'll be able to invest in.
So I want to transition. There's some interesting questions that are already coming in from the audience. So one that seems quite relevant given what we've just been talking about is one of the participants asks, how do you see fundraising for experienced GPs in the midst of this crisis? So is now the time to think about raising a new fund since there might be a lot of opportunities, or does it make sense to wait?
I assume whoever's asking the question is talking about a first-time fund. I think.
Well, they're saying experienced GPs. So
I'm sorry, experienced GPs meaning, yeah. Okay. So we are in the process of closing our next fund, our 12th fund. We are not going to have an issue in doing that, but we did start the process. I guess we started at towards the beginning of the year. And it is, you know, we have a long-standing institutional set of investors, LP investors that have known us for a very long time, have invested in us for, you know, 20 plus years. And so that obviously makes a huge difference. I do think it's going to be important if you're an experienced GP to have experienced LPs as part of your fundraising process in that instance, because I think, again, getting new relationships, new LPs into a fund is I think a difficult thing to do in this environment. Not just the macro environment, but the lack of the ability to do in-person interaction, which I think is important for LPs as well.
Mm-hmm. Yeah.
Yeah, I mean, we're also in the final phase of raising our fifth generation fund, and we where the relationships already exist, there isn't an issue. It's just a question of timing, really. Sometimes there's a a timing issue that we need to give the LPs themselves more time to run their internal processes, but we're not encountering a problem with fundraising. But as Dan says, we started well before this crisis emerged. I think even for an existing manager, I wouldn't particularly want to start a fundraising right now. I think I think the problem there is that the LPs themselves are dealing with massive tectonic shifts in their own portfolio, and they have to find the time to address those and for the situation to settle down. And it's not just the allocation to private equity or venture capital, it's across the board. So if you think about the distractions that CIOs have of major endowments, I mean, it's enormous at the moment. So you can't expect, other than a fairly standard re-up process, to expect to win bandwidth. But there's amazing time to prepare the materials, to develop the stories, to get the organization teed up, to even recruit people, actually, in order to come out of the blocks early, which is what I would, even for an experienced manager, I would recommend.
Mm-hmm. So there's a couple of questions here that I would say are related to sort of a VC allocation question, which is, one of them is essentially about, do you think VCs will shift to holding a larger share of their fund for companies they've already invested in to do, subsequent rounds versus kind of new investments? And another one, which is, do you think we're going to see an increase in internal rounds from existing investors, so without kind of an outside investor to price the round?
Sorry, what was the second question again?
So have you seen, do you expect to see, or have you seen an increase in internal rounds from existing investors, right? So where all of the investors in the next round, are already existing investors in the company.
Yeah. So this is what we saw in the 2008 crisis, and I would expect that to be the case for all the reasons that we've discussed. That it's very hard for a new external investor to get comfortable with a company and a team remotely. So we are looking at the insider capacity of all of our companies together with our co-investors to anticipate that if we have to finance a bridge round or even lead an inside round as the next financing, we would be capable of doing that. So I think the number of externally led financings will be lower, but not the number of financings overall. So I think that's right in general. But in terms of our reserves policy has always been very conservative. So I don't think we're going to reduce the size of our portfolio.
Mm-hmm.
Yeah, I think from our standpoint, the answer to both those questions is yes, meaning there will be more internal rounds. I don't think there's any question of that for the reasons Ann just indicated. And as far as reserves are concerned, we're in the middle of that discussion right now for our current fund. We have a fairly algorithmic, if you want to call it that way, of setting aside reserves, and we have already done that for our previous funds, so that they are what they are. We have a pool of reserves that are based on certain calculations we've done from the standpoint of historical data. But as far as the reserves currently, we are in the middle of that discussion, and I think there's some real discussion around the benefit of potentially increasing reserves at least a little bit to account for the fact that there's no question that more internal rounds will need to be done for good companies, not for companies that are in trouble, but for good companies. So yes, I think that's probably where we'll end up as well.
So kind of a little bit different topic here, which is also, I understand it's slightly out of your space, but it's an interesting one. Do you think that this will have a different effect on, the various type of kind of impact investing funds that have been popping up? I mean, I could kind of imagine it going both ways, sort of supply kind of demand from LPs. Do you think they'll face different sorts of pressures from traditional VCs in this crisis?
Well, I mean, impact funds come in many flavors, and I think that they require the addition of metrics beyond financial returns. And some say they don't trade off financial returns. Some say they're willing to trade off financial returns. I think that they will probably gain support from the DFIs for sure. I think the DFIs will become very important in supporting them into the emerging markets. But I'm less convinced that impact funds focused on developed markets will be advantaged necessarily by this crisis, because I think this is going to be one where we all need to be able to deliver financial returns as well as significant improvement in whatever the product and market is. And I think good venture returns do generate impact. There's no question about it. They help pensioners, they help endowments, and I think the classic venture capital model is really important part of the economy. So I don't see it as a distinction that there'll be an improvement or an argument that impact would be better.
Yeah, I think most impact funds that I'm aware of do expect some kind of return, maybe a little bit, maybe they're willing to have less of return than a traditional fund might, but certainly they're expecting some kind of return, I think. And I think that's what it's going to come down to. I'm certainly reminded of, the big shift into green tech earlier, in maybe a decade ago that happened when people in at least a variety of venture firms were thinking, let's do impact investing. But again, with the idea that we can make a return on it, that turned out to be a very, very unsuccessful strategy for many firms for a variety of reasons, primarily capital intensity. It's very capital intense to invest in those types of businesses. So I think in the end, it'll come down still to returns, at least some returns. If you think about it, the best impact fund in the world is probably the Gates Foundation. Now they use data and they use it very precisely, but they do not need to make a return. And so from that standpoint, you can have a major impact if you're not willing to, or if you're not as focused or not focused potentially at all on financial return. But I don't know of too many impact funds that literally say we don't care about financial returns.
Yeah. So I'm sure this is one that's on the mind of many of the participants. This is sort of shifting away from the investor's perspective. But one of the listeners is asking, do you have any advice for startups who are currently fundraising, it's kind of trying to keep up momentum during the crisis?
Gosh, talk to people you know. It's back to this relationship issue. I think the chances of developing a new relationship are really low in this lockdown environment. And do as much as you can with as little capital as you can, and push out the fundraising if you haven't got that support from your inside investors. Those are the two pieces of advice.
Yeah, I totally agree. I think the number one piece of advice is if you can avoid fundraising in any way, shape, or form right now, avoid it. It is a terrible environment for new fundraising, and even on the insider basis, there are a lot of insiders that I am aware of where they're having to make hard choices there as well.
Yeah.
So it is a terrible time to fundraise if you're a startup. It just, sadly, it is. I mean, if you happen to have metrics that show that you're thriving in this environment, potentially, but obviously the actual lockdown time period has been relatively short, even though it seems like forever, 5 weeks or so, and so I think that's probably not particularly realistic. So I just think you've got to do whatever possible to avoid fundraising, or to Ann's point, go to people that you know and that believe in your story and believe in you. That's about the only thing right now I think that'll work. I mean, potentially you could raise money from somewhere else, but you can also win the lottery too. I just think it's the odds of that are very low right now.
So yeah. So sorry. Go ahead.
Well, I was actually just reflecting. I was going to come back on the impact question for a second, because I do want to make a distinction between impact and ESG, environmental, social, and governance, because I do think that the ESG expectations of LPs on fund managers and fund managers on their companies will grow as a result of this crisis. So how we as venture capitalists treat our companies, how we make these hard decisions, how well we communicate them, and how sensitively that's done, and how our CEOs do the same thing to their workforces, I think will matter in the future. I think how people behave during this crisis will be noticed and referenceable. And so I don't want to take away the importance of ESG as a growing trend in fund management in general, because I think that will accelerate because of this crisis.
Mm-hmm. So kind of something that's probably relevant to both entrepreneurs and innovators. There's a couple of questions here that are, I would sort of classify as being about whether, VCs in general might start looking for a little bit different type of company to invest in. So over the last, few years, we've seen a lot of focus on, companies that have the potential to become unicorns. One of the things about these companies is they oftentimes require a lot of capital. Do we expect to maybe see a shift to interest in businesses that, have interesting ideas or maybe a little bit more capital efficient in terms of where VCs might be placing bets?
Well, capital efficiency is something that we always look for. So I don't think there's that will change. I do think that the math of venture capital is such that, generally speaking, the larger the fund, the bigger the size of outcome that you're trying to achieve. If you're a $50 million fund, the kinds of companies you can invest in and make a very good financial return for your limited partners is different than the kind of company that you want to invest in if you're 500, in our case, $800 million fund, in terms of looking at the potential financial return that company can deliver. So it's really about how big an impact can a company have, and what kind of, how much scale can it achieve, and how powerful is the business idea and the team behind it. There are certainly many businesses out there that sometimes will come to us that are frankly not very appropriate for venture capital, but that doesn't mean that they can't be good businesses. At some level, there's sort of a somewhat derogatory term of a lifestyle business that's attached to some of these companies, but there's nothing wrong with a lifestyle business that is a $30 or $40 million revenue business that drops significant cash flow to the bottom line and employs lots of people and delivers a great return for the owners. So it's just not a venture capital business. So I don't think those dynamics change very much. I mean, we'd love to have the most capital efficient, very big impact, large successful company we could find.
I think that the thought here is more like versus like something like an Uber, you know, or
Well, I think if I was going to reflect on what I think changes, it's actually not at the creation stage or the startup phase that you'll see many changes. What you'll see is a change in how long these companies stay private, and their willingness and the willingness of really late stage investors to finance the growth, the aggressive growth at the late stages. So all the trends that you had in your presentation about staying private longer and fewer and the importance of IPOs in terms of returns, which I don't think will change in terms of returns, but I think there will be a hit to the number of companies who can go public, and therefore there will be an increase in trade sales, and probably there will be there'll be less much later stage or crossover capital, because the public market investors will first of all have to conserve their own cash, but secondly they'll be finding bargains in the public markets, so they won't have to go dip down into private markets to seek returns. So I don't think we're going to see this wave of later stage capital that supported the kinds of late stage growth that you saw in the sort of last 4 to 5 years. But I don't think it changes what we invest in at all. It just changes the way you think about exits, and that I think will change.
Yeah, I think the going back to the question about Uber, you know, thinking about it in the context of an Uber, I think that the you know, the investing, the type of investing where you all you care about ultimately is growth, just the most rapid growth you can possibly achieve, and getting to scale as quickly as you can, and using capital as a competitive weapon, if you will, as a moat. I think those days are probably gone. And I think that, but I think they were, you know, given what happened with SoftBank in particular, I think those days were gone before this crisis hit. I think this will only reinforce that you know, that kind of dynamic. You know, ultimately it is about unit economics, and you know, you know, if you have negative contribution margin, you know, more volume and more scale is not going to necessarily help your business. And I think that sometimes that was forgotten in a lot of playbooks, or several playbooks of large companies that just got to scale for using massive amounts of capital. WeWork obviously being another example.
Yeah. So we're getting near the end of our time. It's been an interesting conversation. I'd like to end on something that's hopefully a little more upbeat. So for the final question, I'd like to ask you, you know, what are some of the, you know, kind of frontier areas that you're particularly excited about right now, that you think are going to be really interesting spaces to invest in the next, you know, couple of years?
Go ahead, Dan.
Sure. We like robotics. We have a couple companies in the robotics space that we're very excited about, that I think is, you know, on the frontier technology side, that I think, you know, are seeing actually real tailwinds in the context of what's going on in this crisis. There's, you know, people would like to automate more, would like to have a situation where they don't have people as close together as they might ordinarily have them. And I think while the trend was very positive in terms of the growth rate and revenue growth rate and pipeline before this crisis, I think this has certainly accelerated that trend.
So I think there are a couple that are in our main focus, but will probably emerge stronger. I mean, one is the sort of overlap between digital and healthcare, whether it's the rapid interpretation of healthcare imaging of various kinds, CT scans, MRI scans, or the rapid improvement in diagnostic testing, or there are some there are 6 of our companies that are all working directly on the COVID crisis in one way or another, whether it's on protein characterization, on image analysis, on the improvement of how protocols are implemented in healthcare systems. So I think this digital health area is one that we've focused on for our entire history, but I think it will grow. And the other one is cybersecurity and of all kinds. As we move more and more online, and I think this crisis is accelerating everyone's move online, all industries, and I don't think that will completely fall back. I think that yes, we'll all be glad to gather together in person, but I think virtual everything, whether it's online business or even this video webinar, will continue to grow as an aspect of our business, and the security around that is there, but it needs enhancing. So the detection of fake videos, the detection of access to, the way fraud is conducted in the online world. I think those are all areas where we're very active, and I think will be needed more, because I think there'll be more exposure, more points of access than there have been in the past.
Great, thank you. So, I mean, this has been an interesting conversation. I think we could probably keep going for hours, but we're scheduled for 1 hour today. So I'd like to thank both of you for joining me for an interesting panel. And I'd like to thank all of the participants for attending this Yale SOM Exchange webinar. Please keep an eye out for future webinars. We will have several more coming up that will be hosted by the school. You should also visit alumni.som.yale.edu to see other upcoming events. Thank you very much.
Thank you, Olive.
Thank you, Olive. Thanks, Ann.